Whenever you start with creating a financial model, it is very important to understand what the financial statements of a model are. In this video, we are going to cover the basics of financial statements that a company creates. Welcome to the module 1 of this entire financial modeling of a startup series. And in this video, we are going to understand the basics of financial statement from scratch. We are going to understand this entire module in a very simple language, and it will help you create a base for starting your work on the financial model. Hi, I am Karan Damania. I am an ex-investment banker turned founder, and through Encoding Careers, we help people build successful career in finance. So let's get onto the screen and discuss the first module in detail. So before starting onto the module 1 of this entire series, let us understand what are the elements of this entire module 1. So it's an introduction to financial statements where we are going to start with what is a company. We are going to understand by legal definitions what does a company mean in India, what is a startup. So again, by the regulatories, what is a definition of a startups, what are the criteria that a company has to follow so that it is considered a startup. Next, we are going to understand why financial statements are prepared. So what is the need of creating financial statements? Can a company run without creating financial statement? This is also what we are going to understand over here. And what is filed? So regulatories need companies to file some of the elements of the entire financials of a company. So here we are also going to understand what are these elements that we need to file to the government as a company or as a startup. So the first part of this entire module is what is a company and India specific. Here we are going to understand the definition of the company, the act that the company follows, what are the various types, and by law what can a company do. So starting with the definition, a company is a legal entity formed by group of individuals to engage in business or trade with the intention of earning profits or achieving specific objectives. That is the definition of a company, where it is saying that it's a legal entity. So it is established by law and by regulatory requirements, and it is formed by individuals. So here a company is run by these individuals who are forming this company, and they are doing it for engaging in business or trade. So here business can be sale of services or products, and trade can be then exchange of product with the other companies. So that is the meaning of business and trade. And the intention of starting a company is that they want to earn a profit or achieve a specific objective. Now the achieve specific objectives refers only to the NGO as a company, because mostly all the other type of companies are established for earning a profit. So that point we will come next, but before that, the act that the companies follow. So it is a separate legal entity registered under the Companies Act 2013. So as you are an individual and you have a Aadhaar card, so that it proves that you are resident of India as a nation. Similarly, to register a company in India, it must be registered under the Companies Act 2013, and it has to follow all the rules and regulation that are mentioned under this law. So as an individual, you follow all the rules that are mentioned in the Constitution of India, and you have to abide by them. So if you are forming a company, you need to follow all the rules mentioned in the Companies Act 2013. So to understand who created all these laws and everything, we will come to that in the next point. So coming to the various types of companies. So there are different types of companies based on the requirements of the individual. So if you want to create a very large company, you then create a private limited and then take it public. These type of companies are created when you want to cater to large audience and scale your business very wide. Next is one person company, which mentions over here by the name one person, that a one single person is running the entire company. So over here only single person is running the company, whereas on the private and public limited size there are many individuals who are running the company together as a group. So next is partnership firm, where there are people who are coming and forming the company and named as partners. In the case of private and public limited company, these people who are forming the companies are called directors, whereas in the case of partnership company, they are termed as partners. And there are different types of regulatory differences in these different types of companies, which you can easily search on the internet, and you will get the differences between these kind of companies. Next is LLP, which is limited liability partnership. It is a kind of similar to partnership firm, but here there can be many number of partners, and in a partnership firm there are only two partners in a company. Next is sole proprietorship. Again, as the name suggests, here there will be only a single, that is sole owner of the company, who has the right to take all the profits and the liability of the company. Next is a NGO. So as discussed above, all the other types of companies that we have discussed, like private limited, public limited, one person, partnership firm, LLP, sole proprietor, all these companies are formed to earn a profit. But an NGO is formed to achieve a specific objective. It could be to spread literacy, it could be to donate food to the needy person, or whatever the objective of the entire organization might be. So that is what comes under achieve specific objectives. So here we saw that what are different types of companies. Next we come to what does a company do and who is it managed by. So a company pays taxes, owns assets, signs contract, raises capital in its own name and not in the names of owner. And this entire company is managed by board of directors. So this point is very important to understand. Here it is mentioned that a company pays taxes. So what we are trying to say, that whatever the revenue is earned by the company, after bearing all the expenses, a company itself has to pay its taxes, and it is not exempted by laws in terms of paying taxes. It owns asset. So as an individual, if I buy a phone, that is asset under my name, but I can buy assets in the name of company as well. So the phone then belongs to the company, but it can be used for business purposes. So that is what is meaning of assets. Any asset that is owned by the company should be used for business purpose only, and not for any other purpose of personal use. So that is the main thing. Then company can sign contracts. So a company can go into partnership with other companies as well to develop business, and that is what is important over here, that a company signs contracts. So company can give an authority to a person to sign contracts on behalf of the company. So what this means, that if company A wants to tie up with company B, then a contract is created where it is mentioned that company A is going to tie up with company B, and they are going to ahead to XYZ businesses together. So a company A will have an individual who will then sign on behalf of the company, and company B will have an individual who will sign on behalf of company B. So that will then legally be abided by the law, that this contract is verified and signed by the both of the companies. So that is what is meaning of signed contract. It raises capital. So a company can raise capital from other people to expand its business. A company in itself doesn't have any money. It has to borrow money or give equity ownership in exchange of the money that is received in the company. And that is what is the meaning of raise capital. And it does in its own name. So if a company is raising capital, the capital will go into the company and not the owners of the company. So let's assume that company A borrows 1 crore of debt. The entire debt of 1 crore will go in the assets of the company in the cash balance, and there will be a liability which will be outstanding in the liability side, which means that a company has to pay 1 crore back to the bank from where it has taken loan. So over here, once again, it's the cash becomes the asset of the company, and this entire 1 crore cash should be used for business purpose only. So that is what is the meaning of raise capital in its own name and not in the name of owner. And the entire company is managed by board of directors. So as we saw earlier as well, that a company authorizes a person to sign contracts, so that person can be from the board of directors. So entire company is run by the managing directors and the board of directors based on the roles and responsibility distributed between them. Now each company will not necessarily have board of directors, because as we saw earlier that partnership firms have partners, and these partners are then liable, and these partners have the responsibility to run the company. Similarly, on the LLP side, there are limited liability partners. So here also partners have the responsibility to manage and run the company. And sole proprietor is a single person who is making decision on behalf of the business. So here also he will not be considered as a director. He will be a sole proprietor of the company. So that way we understood what does a company mean in India based on its definition, the act that the company follows, what are the various types, and what a company can do and who is it managed by. Next we are going to understand what is a startup. So that we are going to understand in a similar manner, where we are going to see what is a definition of a startup. Then we are going to understand what is the regulatory requirement of being considered as a startup with these 2 points. So the first point, which is the definition, is saying that a startup is generally defined as a new innovative company typically operating under private limited partnership or LLP. So that is a basic definition. This is not mentioned by the laws, but this is a general definition which can be taken to understand what a startup means. So here it is mentioned that startup is generally defined as a new, right? So the word new comes over here, that it is a new innovative company, right? So its product and services are innovative to the industry, and it is doing something new in business, and it is operating under a private limited partnership or a LLP. So startup has to be registered as a company, and it could be a private limited, a partnership firm, or a LLP based on what is required by the individual who is running the company. Next, who is then considered a startup? It has been incorporated or registered for less than 10 years. Okay, so here we got to know that a company to be considered a startup has to be registered for less than 10 years, or incorporation should be less than 10 years. So if I have a company who is, let's assume, registered in 2020, and it's a new innovative company registered under private limited, then I am definitely considered a startup. Yes. And if a company is formed in 2014 and today is 2025, then it won't be considered as a startup, since the incorporation date is greater than 10 years, right? So that is not considered a startup. Now, to qualify, a startup must also have an annual turnover not exceeding INR 100 crores. So this is also the point which you need to consider while tagging a company as a startup. So the first rule is that a company must be 10 years or less, right? So that is the first law. If it is more than 10 years, then the first criteria is not qualified and you will not be considered as a startup. The next correct the next criteria over here is that your company should not have turnover more than 100 crores. So if these both criteria are satisfied, then only a company will be considered as a startup. So let's assume an example that company A registered in 2014 and has a turnover of 50 crore. This is not considered as a startup, since the criteria of 10 years or less is not qualified over here. The second criteria is qualified, but both of these criteria has to be qualified to consider as a startup. And let's consider a second company B, which has a registration or incorporation date of 2016 and has a 10 crore of revenue. Then this is definitely considered as a startup. There is a committee in India named as DPIIT, where you have to submit all the documents necessary to get yourself considered as a startup. So here, for an example, we have taken our company's recognition as a startup for your understanding, where this is the certificate that you get when you apply for the Startup India certification, and you are then considered as a startup. So here we can see that there is a certificate number that you get, which is DIPP, and a number ahead. Then there is a mark of Startup India logo, which mentions that this is a certificate of a startup, and it is promoted by Department of Promotion of Industry and Internal Trade, that is DPIIT, which we mentioned earlier. And the certificate then mentions that this is to certify that MKD Careers and Code Private Limited, which is the name of our registered private limited company, incorporated as private limited company on 27 November 2024, is recognized as a startup by DPIIT. The startup is working in education industry and skill development sector as self-certified by them. So this is what you have to mention in your application while you are applying for Startup India, that what is the sector that you are working in. So for us, we are working in the education and skill development sector, and we have to self-certify them. Like, we have to give an application for that. Since we were established in 2024, we were less than 10 years of incorporation. We had the eligibility to apply for this certification. And also we did not exceed the turnover of 100 crores, where both of our criterias were satisfied, and then we got this Startup India certification. And in between of these 10 years, if we cross any year by 100 crores of revenue, we will not be considered as a startup. So here there is a date of issue when this certificate was issued, and then there is a date of when it is valid up to, that is 10 years of period. So that is about the certification of startup, and through this we have now understanding what is a startup in India. And we got to see what are the two criteria that a company has to meet to be considered as a startup, right? So that is entire meaning of a startup in India. Next we are going to understand why financial statements are prepared, what are its legal requirement in India. So to understand these legal requirements, we will first understand what financial statements are. So financial statements include three elements, right? That is P&L, balance sheet, and cash flow statement. So these are the three elements of a financial statement. So why does law require us to create these three financial statements? So the number one is that we have to file financial statements annually, that is every year, with registrar of companies, that is ROC, and comply with MCA reporting norms. So as we see over here, we have to file every year to this ROC and MCA. So first we will understand what ROC and MCA means. So over here we will start with MCA first. So MCA is Ministry Corporate Affairs. So as the name over here suggests that it's a ministry, that is it's a government department or a government body that is managing all the corporate affairs. Since company is a corporate in its own, it is entirely managed by MCA, and there are different departments under MCA, where ROC is one of its office, which is registrar of companies, and has its own function, which we are going to understand next. But first we are going to understand what MCA means and what does it do. So MCA is a body which is overseeing all the laws of the corporates. So here what are the main laws that are in India? So number one is the Indian Companies Act 2013, which we saw earlier as well, where it was mentioned that every company in India has to be registered under the Indian Companies Act 2013. So over here the overseeing of the law means that what needs to be added or deleted from the law. The next law that it regulates is LLP Act 2008, which is once again the law where all the LLPs, that is limited liability partnership companies, are registered under. Here also it manages the law and sees what are the additions and deletion that needs to be made in this entire act. And finally the third one is Insolvency and Bankruptcy Code, that is IBC, which was formed in 2016, where if any company is facing any insolvency. So insolvency means when a company is struggling very much to sustain in the industry, and if it has a lot of debt and obligation on their head, then they have to apply for the Insolvency and Bankruptcy Act, where all the assets are then sold off to pay off the liabilities that the company has. So that is all taken care by the IBC Act 2016, where also the MCA then oversees all its laws and ensure that companies are able to work through it. The main thing that this MCA, that is Ministry of Corporate Affairs, does is that it ensures that companies follow good corporate governance and are being under the law all the time. So they are seeing that the companies are not misbehaving and taking unfair advantage of people. So next we understand about ROC, which is a office under the MCA. The main function of ROC is to regulate all the companies and LLPs in India. So that is what the office of ROC has to do in India. They have to see if all the companies and LLPs in India are following all the regulations and laws that are applied on them. It has to also maintain the databases of the company, where anything that is filed by the companies based on the regulatory requirements is all managed by the ROC, and they have access to all the documents that companies file. Now what are the types of filing that the company does? So over here, if the company is changing any director in their company, then it has to be filed. If they are raising capital, then it has to be filed. If there is change in financial statement, or every year the financial statements need to be presented to the government. So that is also done by the ROC, and they maintain all the database of companies. As we talk about why financial statements are created, we saw that the ROC maintains all the database, and as the law says that companies have to every year file the financial statements with ROC, so that they can track that the business is done in legal manner and there is no unfair advantage being taken. So this becomes the first element of filing the financial statement, where the second element of filing financial statement is to comply with income tax department. And when a company is filing for its income tax returns, that is ITR filings, it has to submit balance sheet, PNL and cash flow statement, so that the income tax department comes to know that whatever tax has been calculated, it is correct and the companies are paying appropriate taxes to the government. So that is what the second element is about. And finally the third element is maintain books of accounts to track business metrics. So this is one of the most important. Even though if there are no requirements by government bodies or income tax department, a company should create its own financial statement to understand how the money is flowing into the company, how the revenue are generated, what are the expenses, so that they can track if they are on the correct path on this business journey, and if the business will be sustainable or not. So in this point we now understand that why financial statements are created and where are they being submitted as a legal requirement. Now finally we will understand what is filed while you are submitting this financial statement. We saw earlier that there were three financial statement elements, that is PNL, balance sheet, cash flow statement. These are the most important ones when you are filing your returns and when you are submitting to the ROC. But other than that, there are requirements of notes to account, where you are explaining each and every line item that you are submitting to the regulatory bodies. If you are submitting the PNL, then you have to show how is the tax calculated, what is the depreciation, what is the interest rate, and you have to provide details about the line item as well. So if you are saying that you have an asset, how are you depreciating it? Is it depreciated at 10%, 20%? And the details have to be mentioned in the notes to account. So when these regulatory bodies are doing compliance and ensuring the feasibility of the financial statements, so that is about notes to account. And finally auditor's report. So auditor's report is what you get when you do audit of the financial statements of your company. Now this audit has to be done by a outsider. It could be a CA, a CMA, or whatever the regulatory requirements are related to a auditor. So when a auditor does an audit, like a audit is a check of your financial statement, where he is having a look to the financial statement that you have created, and he is giving an opinion related to that. Is all the things mentioned in the financial statement correct or not? So if the financial statements presented are wrong, then you are going to face severe penalties from the regulatory bodies, because you have not followed the laws. So while you are filing for these regulatory requirements, like to the ROC, to the ITR, you have to then file these five things, where it is compulsory for all the private limited and public limited companies. But in case of partnership firm and LLPs, the case might differ. So next we are going to understand with an example of Tata Steel, which is a public limited company, and we are going to see its annual report and see what are the things that these company has filed in their annual report, because these annual report has to be submitted to the regulatory bodies, as we saw earlier. And in this annual report we are going to see that all of these five elements are mentioned. So this is the annual report of Tata Steel, where it is a very detailed document which includes all of this title about Tata Steel, its strategy, its value creation, its leadership, its stakeholder engagement, materiality, the statutory reports, and finally we have the financial statement section. Now in this financial statement section we are going to see the consolidated one, because that is what goes to the regulatory bodies. Also when company has lot of subsidiaries, it has to create its standalone version of financial statement as well. But here we are going to understand how a consolidated financial statement is filed to the regulatory bodies. So we are directly going to move to that section of the annual report. So we are now at the financial statements of Tata Steel, where the first element that they have submitted is the balance sheet, where they have given every line item of what is the non-current asset, what are the current asset, the equity liability section.
They have also mentioned the notes that are related to that particular line item. So we can see that they have given third note for plant property equipment, capital work in progress, which will be then given in the notes to account section along with the page number. So that detail is a public limited company's annual report. Then there are names of all the directors of the company. So we can see the chairman has done its signature and it is written for and on behalf of the board of directors. So company is filing its financial statement by authorized board of directors. And we can also see that PwC, that is Price Waterhouse and Company CA has done its signature here as well. So that this is a audited report. Next we see that they have submitted their profit and loss statement, where they have given revenue from operations, income, expenses, the entire tax expense, the profit for the year, the EPS, and every line item has its note related to it. Finally, we have changes in equity, and then the final element, which is statement of cash flow, where we have three elements: cash flow from operations, cash flow from investing, and finally the cash flow from financing activities. And then there is closing cash, which then goes to balance sheet. So that is about the three financial statement which is submitted in the annual report. Next, after the three financial statement comes the notes, where the company submits a note related to each and every line item. While reading through these notes, you will understand what the company is doing in business. So here it is very detailed, and if one wants to understand the business in detail, then they should go through this. And it goes on and on and on and on for every line item. And finally, there is independent auditors report, which is the fifth element, where they are mentioning what the opinion on the financial statement is. So I'll just go through the high level opinion, where it says we have audited the company consolidated financial statements, referred to as holding company in its subsidiaries and its associated companies. Consolidated P&L including OCI, the equity, changes in equity, the cash flow statements. Like, this is the main important thing in our opinion, and to the best of our information and according to explanation given to us, the aforesaid consolidated financial statements given the information required by Companies Act 2013 in the manners so are required, and give a true and fair value in conformity with accounting principles generally accepted in India. So this is the main line which you have to look in the auditor's report, if the financial statements submitted are giving a true and fair view or not. If this is not given, there is some errors in the financial statement what has been submitted, and then the CA has to note out which are the elements of error in the financial statement. So that is all about the five elements of financial statement that was submitted to the regulatory bodies through this annual report. So I hope that through this video you would have gotten an understanding about the financial statements of a company, what is a startup, what is a company, and why financial statements are prepared. In the upcoming sessions, we are going to go in detail about financial modeling and understand everything about financial modeling with practical examples. And by the end of the series, if you follow alongside practically doing entire financial model, you will be able to create financial for any of these startups. So that is how detailed the entire series is going to be. So if you find this video valuable, do consider liking this, and if you are new to this channel, do consider subscribing to Encoding Careers. So see you in the next one. Until then, this is Karan Damania taking your leave.